I read a couple of notes from banks saying that actually at the end of this price war, the big winner could be U.S. shale. Is there any truth in that? How would that happen? That is one of many possible outcomes. I'd have to say that we wouldn't be quite of that school of thought. Ultimately, we are entering a period in the oil market where the total amount of future oil demand that there will ever be increasingly looks like a finite number. It might not be a number that we quite know, but oil demand is not growing in an unbridled fashion anymore. And with that, the total amount of oil demand that lies ahead of us looks somewhat finite. And in a market like that, market share becomes fundamentally more important. And when market share is fundamentally more important, then you would expect the locals producers to be far less willing to support prices at levels that allow others to gain market share. And in that scenario, you'd simply expect countries like Saudi Arabia, other GCC countries, Russia, to fundamentally protect that market share, and they simply sit lower on the cost curve. Look, we're living in unprecedented times, and we should consider many things that seemed, very unusual only a couple of months ago. But our reading is that the true low-cost producers will simply, from here on, defend their positions for some time to come. Martjin, where do you see the price of oil going? And is there a danger that it goes to, 10, even single digit, but because of a lack of investment, then it spikes back up to 100 in 2-3 years?
So in the short run, we draw the same conclusion that many others have already drawn, is that the supply-demand balance looks exceedingly weak. Frankly, whether you model 15 million barrels a day of demand destruction or 20 or 25, at some point, that doesn't sort of quite matter so much anymore. We end up with a supply-demand forecast that basically would lead to a filling up of all of oil inventory capacity that we have globally sometime in May or early June, when we reach tank tops and the oversupply continues from there on. The only way to then balance the oil market is for the price to drop to such a low level that it backs out physical supply, as in supply from already producing fields. And the oil industry is very capital intensive, but it's very light in terms of operating costs. So the price that you would need for people to shut in already producing fields is exceedingly low. And then you end up with price realizations that may need to fall towards $10 a barrel, maybe for very brief periods, even lower. So from that perspective, the near term looks very weak.